Wanted to bring Frank Scanavino on this morning. Frank has been on our meetings a couple of times previously. He is an expert in the SBA loan program. He's been doing this for a long time. I worked with Frank for many years, and I've worked with Frank on deals since I left SBA lending a few years ago. And Frank has been invaluable to me and my clients since. And I wanted to bring Frank on this morning because there have been a couple of major changes or additions, whichever way you want to put it, to the SBA loan program, 7A and 504, that are really significant. So everybody, welcome Frank Scanavino. Frank, take it away. Tell us all about the new updates and what you think about everything and how to strategize moving forward.
Thanks, John. Again, this is Frank Scanavino. My company is International Marketing Group, and we are a packaging and processing company for SBA loans. The update that John is talking about is that the SBA always had a maximum amount of SBA funding a client could have, which was $5 million. So if you had a $5 million loan out, you couldn't get another one for $5 million. Under the new law, you can get a 7A loan up to $5 million, and you can get a 504 loan, which goes to $15 million, but the actual amount that they guarantee is $5 million. So now they've actually doubled the amount of SBA financing that you can get. You really need to work on getting the 7A first before the 504. But what that simply means, it opens up a new avenue for us, John, where we can now do a business acquisition, and with the acquisition of a building, where we can do the acquisition of the business under a 7A, and then the acquisition of the building under a 504. In the past, well, it is even true today, 504 loans are only for commercial real estate or very, very large equipment. So that's what it's for. So you couldn't use it. So if you were going to buy a business, including the building that goes with it, you couldn't do a 504 loan and cover both purchases. You had to do it now under a 7A, which the 7A is at a higher interest rate. So we wanted to try it. Now we're able to split it, where we can do the 7A for the business acquisition over a 10-year period, and we can do the 504 loan at the lower interest rate for the purchase of the building. So that gives us a nice advantage in doing that, in the purchasing. All right. So that's the change.
Yeah, go ahead, Frank.
Basically. That was the basic change in the law. Okay. There's a couple of other things I want to talk about too, John, if that's okay.
Absolutely, please.
I want to emphasize the change also in what the SBA is doing with the banks, because that's important. So under a normal SBA loan, the SBA guarantees 75% of the loan to the bank. Okay. So if you're buying a building, they guarantee 75%. Under a 504 loan, the bank only gets a 50% guarantee. They don't get a 75. That's why a 504 is a little harder to get, even though the interest rate is lower. But there's a change in the new law that happened last summer with the big, beautiful bill, which I want to get involved in. They have made it where manufacturing companies under a certain NAICS code, the government will guarantee 90% of the loan to the bank, which makes it much easier to get the loan, whether it's 7A or 504. Same thing with international companies. So if you have a company that is actually exporting goods, which a lot of California companies are, Nevada and California companies are exporting, they also, if they're under a certain NAICS code, can get the bank can get a 90% guarantee on the loan, which makes it much easier for them to get the loan under that program. So the first change is this change with the going with the $5 million for 7A, $5 million 504. Then the next is this 90% change for these manufacturing companies so that it's easier for the bank to approve the deal. They're at a much less risk factor on that deal. And then the last thing I want to talk about, John, is the change in the tax law for the write-offs for depreciation and amortization.
Yeah, that's a big one.
We are having our best year in helping clients with the SBA, with the purchase of buildings and the purchase of businesses. If you're going to do a business acquisition, you want to do an asset purchase, because any hard assets that are part of that purchase, you get to write off 100% in year one. All right. So what happens is I have and I've explained this before, I have a client that has very high income. They are looking to purchase a business that has $400,000 of hard assets, which they can write off in 1 year. They're going to save about $125,000 in taxes. So when they said to me, they don't really even care if the business makes a lot of money as long as it covers the loan, because they're going to save $125,000 in year one just on taxes for the assets. So keep that in mind for business acquisitions. On the purchase of buildings, we are having our clients do cost segregation, which means the buildings get broken down, and a lot of that building gets depreciated much faster than the normal 39 years under the normal depreciation schedule. So there's advance. And John and I know this because we close the client at the end of the year, and that the client's accountant estimated by buying the building at the end of the year, he's going to save himself probably $100,000 in taxes. So those two things, purchase of a business and purchase of a building, these are hard asset purchases that get accelerated depreciation and accelerated write-offs so that clients can save a huge amount of money on taxes over the next couple of years. So definitely take a look at that. That's been a big winner for us and a big winner for our clients for this year.
Frank, do you think there are going to be any specific industries that are going to really benefit from the new 5 and 5 agreement?
Well, it's open to any industry, John. So that doesn't make any difference. What it does is it gives the ability. Again, the 504 is just for the purchase of
Property.
real estate, basically. So it's really people interested who are renting now, which, by the way, if you're renting, it makes no sense to rent. I mean, we look at it, we say that you're helping somebody else in their retirement plan when you rent your building, right? Yep. Because what will happen is if you purchase the building, even though you have a large monthly payment, a portion of that payment you make every month goes towards the equity in the building. So you're building your own retirement, so that in 25 years, you actually have an asset there that you can sell, so that you get your money back. If you paid rent for 25 years, you get nothing back, right? You have no value there. That's all gone. So it makes sense for anyone that has a business now that feels comfortable to be able to purchase a building. And the nice part is, if you purchase an existing building, you only need to occupy 51% of the building. So you could lease out the remaining part of the building and actually have rental income coming in to help pay for the building. So there's no reason now, if you're a stable business, not to look at trying to buy a building for your business.
For sure. And how about, just to throw a curveball at you, let's say I'm a business owner and I buy a property through the SBA 504 program, and 3 years later I get an offer for the business, and I'd be nuts to say no to it, and I want to sell the business outright. What happens to my position in the property at that point? What happens? What do I need to do? Or is the government going to force me to sell the building? How does that work in a situation like that?
They don't force you to sell a building. So you can continue to rent the building at that point. You have to keep making your payment. Obviously, you're not going to make your payment. They're going to
Right.
come after you. But I've not seen where that situation's occurred and they haven't, that where they made them sell the building. A lot of times they're buying another bit. Where it comes into play a lot more, John, is where they buy the first building and it's not big enough. They
Mm.
grow the company and they've outgrown that building. So what happens is now they want to buy a second building. All right. So now they have to go back to the bank to say, look, we're going to rent the first building, but we're going to buy a second building that's much larger. So the banks will work with them to make sure that they can purchase the second building while keeping the rental on the first building.
Gotcha. Okay.
Because the bank has the lien on that first building. So
Right.
they wind up helping the client purchase the second larger building.
Right.
That's
I mean, look,
more the case of what happens.
right. And
Right.
this is great information to know in the event that if you are working with a client and they're leasing, as you were saying, and maybe they've been on the fence about purchasing, and maybe one of the reasons they may be on the fence is that they don't know if their exit strategy is going to say, hey, I'm going to look to sell my business in 3 to 5 years, and what happens to the building after that. So definitely great information as far as being able to explain to clients what their options are, and if they have any kind of if they're risk adverse or if they're wondering what would happen in that particular instance, to let them know that what the facts are.
Yeah, and the other thing is we can do, that's why we tell clients the first step is to do an analysis to see how much you could borrow to determine the size of the building you can buy. Because you want to try to buy a building bigger than what you need so that you can grow into it, but you can also rent part of the building
Right.
until you actually do have that growth. So that's something that we do. There's no charge to clients to do an evaluation. We get the last 3 years tax returns on the business and a current financial statement, a business debt schedule. I'll do a cash flow analysis and we'll let them know how much they can borrow. And at that point, they can go out and look for a building that matches what they get approved for. So we're available to do that for anyone who needs that analysis done.
Okay. Are there any specific industries right now which lenders are favoring, and are there any particular industries right now which are unfavorable to lenders that are having a difficult time getting any SBA financing?
So businesses that are good or any types right now, they're looking for manufacturing businesses. As I said, because of the guarantee, they get a larger guarantee. They're
Hmm.
looking for those types of businesses, anything involved in manufacturing, anything involved in distribution of products. That's what they're looking for, especially export deals are great deals too. If they're doing any exporting whatsoever, it could be a tenth of percent of their revenue, it still counts as export business. So that's something that they're looking for.
Gotcha. Okay.
Businesses that are tough to get done. Hotels are good. Motels are tough.
Now, why is that, Frank?
Because a lot of motels have longer term residents who stay in it. So it's a little harder to get them done. And they're usually much smaller and they're older. So it's a little more difficult than a regular hotel or flagged hotel. Flagged
Yeah.
hotels are easier. Unflagged or motels are a little harder to get.
Okay.
Gas stations are tough, although we do have lenders who will do gas stations. So that's a little bit of a tough industry right at this point, but it still can get done. Trucking
Is it
companies, again, they are a little hard to get, but we
right?
still get them done, but they're much more difficult. You have to be much stronger, especially the individuals behind them in order to get the loan.
Now you brought up gas stations, which is a great point. A lot of gas stations that are unbranded, they're making an absolute fortune right now
Yeah.
with gas prices. So, if you do you think that maybe a year or two down the road, that numbers will be skewered a little bit as a result of the increase in oil prices that is affecting on the positive side businesses like gas stations, businesses like even oil change shops right now, so that the price of motor oil has been going up, and it could potentially skyrocket from here, and that might artificially inflate what real revenue growth is going to be for a lot of these companies. So, what do you think about that?
Yeah. So if there is because they look at 3 years tax plus the current financial, if they see a downtrend in revenue, they're going, as long as the percent bottom line profit stays the same and they're good cash flow wise, they're just going to need an explanation for the drop in revenue, which can be many different reasons. Like you said, it could be that the gas prices for 1 year are much higher, so the revenue is going to be higher. I mean, it has nothing to do with, they're still making about the same amount of money off that revenue, right? The same percentage. So as long as the percentages remain, we can get over with an explanation. So that's not going to be as large an issue. If there is truly a detriment to the business where there is a true reason for the drop in revenue, that they are losing clients or that the industry is changing, yes, it's going to be very difficult to get a loan at that point. But if there are explanations and they're still doing well, it's not going to be an issue to get the loan.
Okay, gotcha. And I'm guessing that with the whole new love that the SBA is showing the manufacturing industry, that's going to help ancillary businesses like distributors, right? Because
yeah, that's why I said distributors are really good, because they're going to start to show some good increases.
Right.
That's why one of the things is there's a big push for more manufacturing in the U.S. Obviously, that's one of the president's prime objectives, is to bring more manufacturing. And of course, all of those distributors that supply to those manufacturers are all going to increase in revenue. Again, this is where we want to really push, because of not only will they get more revenue, more income, but now they get bigger tax breaks, right? So they're going to keep more of that money in their pocket with the new tax laws. So it's been really a nice combination for us. That's why I think, regardless of what's happening out there, there's going to be an explosion in business over the next 2 years because of everybody starting to realize what's happening with that change in the tax law.
Now, from going back a little bit through the whole PPP, I call it a debacle, for lack of a better word. Are banks having to write off any kind of significant bad loans as a result of the PPP loan program? And is that going to in any way affect any future dealings from the SBA dealing with those type of lenders that have had these issues?
Yeah, so it's not the PPP loans, because those loans were forgiven. So those were okay. It is the EIDL loans.
The idle loans, yeah.
And what the government did right after the pandemic was they guaranteed 90% of the loans, all loans, to the banks for about an 18-month, 2-year period of time. And they pushed for people to get loans. And of course, you know what happens when you push not do the proper work, you're going to have a lot of problems. So the SBA has been cracking down on banks for not particularly clients. So to get a loan, the qualifications for a loan today are the same as 25 and 24. It is the problems that they had in 22 and 23. So they are cracking down on banks. So we had a deal, John, I didn't even tell you this. I had a deal that was supposed to close in April. And 2 weeks before the deal was supposed to close, the FDIC closed down the bank.
Wow. Holy cow, man.
We lost. We didn't lose the deal because it was a really good deal and we'll just get it done somewhere else. But the fact is, the FDIC actually closed the bank. That's how bad that particular bank was in the pandemic loans that they gave out, and all of them that went bad. We have banks where they're not allowed to do refinancing of loans anymore. So what happened was, back in the pandemic, they were refinancing a lot of loans because of the lower interest rates that they were showing. And of course, all those loans that they were doing refinancing have started to go bad back then.
Mm.
So it's been an issue. That's why we have to do the analysis work that we do, because a lot of the banks now say, we want to see that you qualify under a certain cash flow coverage ratio for 24, 25, and for the first quarter or so of 26. So I have to hit that coverage ratio. Before, we could hit it in 25 and 26, maybe not 24. Now they're looking at going back. So it's a little harder to get, but we're still doing a lot of loans because of the change in the tax law.
And then just real quick, Frank, because I know it's an industry which at business brokers we deal a lot with, and that is the restaurant and food industry. What are lenders' feelings towards restaurants in general? And I guess we're really talking maybe QSRs and fast casual restaurants, ones that are capable at least of getting SBA loans. What's the status on the SBA lending market towards towards individuals that are looking to acquire QSRs or any type of food business these days?
Well, franchises are preferable, obviously, because they have a history, and they have to be they have to be an approved uh, franchise under the SBA. So if you go to the SBA website, sba.gov, you can look up what franchises are acceptable to the SBA. And if they are acceptable, we could probably move forward with a loan for that franchise. It is much more difficult if they are not under the SBA, or if they are single types of unique restaurants, right? You have a chef wanting to open up a restaurant. It's not a franchise. You just have to make sure, John, that everything is positive. So what I try to tell people is, if you've been in business for 2 years, 2 full years, what the SBA looks at is the credit history of the owners. It looks at the collateral available, and it looks at the cash flow coverage ratio. And what I tell people is, I really need 2 out of 3 to be strong, right? If you're weak, if you don't have great credit, but you have good cash flow and good collateral, we'll get the loan done, right? In a restaurant where you're a single restaurant, I need all 3 to be strong. Otherwise, there's no chance you're going to get the loan. You cannot be weak in collateral. You cannot be weak in cash flow or credit and get the loan. A franchise, you're buying a franchise, I can be 2 out of 3, but not a standalone restaurant. And that's the difference of the analysis work that we have to do beforehand to make sure before we even go forward. You know, we're regulated under the SBA, John, as a packaging company. We're required to do this. We are not allowed to contract with a client to do the packaging and help them through that underwriting and closing process unless we first do the analysis to make sure that they're eligible under the SBA. So that's the first step, is to do that analysis work. And that's when we'll look at the industry they're doing compared to the information that we receive.
Great information. And if you're a business broker and you're getting a lead for a QSR, now you know the first thing you got to do is, if you feel that that business is going to have to be lendable, is to go onto the SBA website and make sure that they are eligible, because you may save yourself a whole lot of time and a whole lot of aggravation by checking on that first.
We still want to be able to see the client because they could be very strong in certain areas. Maybe they have a lot of investment property, so they got a lot of great collateral that they could put up against the loan. So again, we'll want to look at it, but it is much more difficult if they're not an approved franchise.
Right. Scott, do you have any questions for Frank?
Yeah, I guess my one question is, under that scenario where someone purchases the property, they occupy 51%, and then they outgrow it, and so they're going to move their business, what happens to the first property? How does that go with that loan?
As I said, what the bank will work with them as far as them buying a second building that they're going to move the operation into, and convert the first building into a full rental building. They'll take a look at that. They may,
Just want to make sure the loan doesn't get called, I guess.
right. The loan, SBA loans cannot be recalled. So they're not going to recall the loan. They'll work with the client as far as the rental goes and fund the second one. Where it comes into play is if the client is actually retiring, right? They're going to sell the business and keep the building. Normally, they're not going to retire for many years. So there's probably not a lot left on the building to be owed. And they can work something out with the bank as far as even leaving the loan in place or refinancing the loan to a lower amount or converting it to a commercial loan at that point. Because honestly, Scott, if they've owned the building for 15 years, they could just convert it to a commercial loan because it's going to be such a low LTV. It's not going to make a difference after they make 15 years of payments. So that's not going to be an issue. I'd like to talk about one other thing, John. Under the 7A program, we actually can do 100% financing for the purchase of commercial real estate. So I want to keep that in mind also. We didn't talk about that.
Okay.
But it's the only place you can get 100% financing. I think I remember I on our last one, this seminar that we did last time, we had a client that was buying a building for about 2.8 million. We actually got him a loan for 3.4 million. So not only did he get 100% financing on the building, but he got money for renovations and working capital money. So that is available. Now they are a very strong company, right? They hit all three. They had great cash flow, they had good collateral, and the credit history of the owners were top notch. So we were able to get them well over 100% financing on the building. So that is available to clients. They have to be in business more than 2 years, and they have to show really good on all three sections that the SBA is going to look at.
The only other question I have is, when would a business broker engage your services or contact you? When would be the right time in a discussion with a potential buyer of either real estate and or business?
So it can be right in the beginning. John, I just did one for you. Someone looking to eventually buy a business, but she wanted me to do an analysis on her own personal information. So I did the analysis and said, based on your information, this is as large as you can loan that you can get in purchasing a business without taking into effect the income of that business, which now means you can even go higher, right? So it gave her confidence now to go forward in looking for the business. So it could be as early as that. But normally we get involved once they find a business, and then we gather the information from the business and from them personally. I put together this cash flow analysis and let them know how much they can purchase, what they qualify for on the loan, so that we can figure out a way to work with the broker to negotiate it, whether it's a straight buyout, more money down payment, maybe it's a partial seller carryback. So however we'll work with the broker and the buyer as far as trying to get the deal done if they really want to buy that business.
What if it's
Awesome.
an existing business and they just want to buy the real estate? It's
Yeah,
not
that's
really buying the business.
Well, that's what John and I did at the end of the year, right? He was in business, wanted to buy a building for his business, or even buy the building that he was in. That's really simple to do, especially if they're buying the building they're in. So that one we can, as long as they qualify under the cash flow ratio, which they do, because I've done it. This is, sometimes it's crazy. Not so much in California, because buildings are overpriced in California. Land and buildings are overpriced. But I've done it in a lot of other areas of the country where they are actually, where they buy the building they're in, and their payment is less than what they were paying in rent. So it is, it made no sense for them to continue to pay rent.
And for everybody who's watching this, keep in mind Frank can help you out no matter what part of the country that you're in. So he's not limited to just working with businesses in the state of Nevada. He works nationally, any type of business, any city, any state. And Frank, why don't you let everybody know how they can contact you in case they need some help with an SBA loan?
Yeah, so you could contact me by email, and my email is F as in Frank, S as in Sam, C as in Charlie, A as in Apple, N as in Nancy, at I as in Ice, M as in Mary, group, GROUP, LLC.com. So it's fscan at imgroupllc.com. And you can call me direct on my cell, 702-503-3096. And I'm more than happy to review any of your clients that you have and whether they're buying a building or buying a business. Or if they just
Awesome.
need working capital, we're more than happy to help them with just working capital. That's one of the things, John, just quickly to go over with you. There's 3 layers in funding under the SBA. So 150,000 and less is considered a microloan. What's nice about that deal is anybody, it's a 90% guarantee to the bank. So the banks are looking for that 150,000 or less, easy to get done if they need just working capital. The next level is 350,000 and less. That one is basically the same as a 75% guarantee, but the requirements are less. A lot of banks don't require collateral for 350 or less. There are a lot more banks that do deals 350 or less. So for instance, community development corporations that do the 504 portion for the SBA loans, they're allowed to now do 7A loans for 350 and less. So you have a lot more banks interested in doing those loans. And then above 350, that's where you get the standard of what we're talking about,
Right.
which you have to qualify under the cash flow, the collateral, and the credit. All right.
Yeah, that's great info. And your client that needs only 150 grand today, they may need 1.5 million a year down the road. So
Well, that's what we're looking for, right? So we're looking for somebody who needs some working capital to expand their business. So eventually they'll buy a building. So that's where we're trying to help them.
awesome. Well, appreciate you coming on today, Frank. Great information as always, wealth of knowledge. And I encourage anybody who's watching this video, if you have any questions in regard to the SBA loan program, reach out to Frank. Obviously, he's got his pulse on everything that's been going on. And, the SOP, the standard operating procedures for SBA, they change quite often these days, where it used to be maybe once or twice a year an update. Things are evolving quickly. So you have just another source to rely on.